Imagine a world where simply uttering the words "gold prices will soar" could land you in hot water with the authorities. That's not dystopian fiction, that's the stark reality unfolding right now, in the heart of China's gold empire. Chinese regulators in Shenzhen, the pulsating nerve center of the world's largest physical gold market, have unleashed a sweeping crackdown on what they're labeling illegal gold trading, and it's sending shockwaves through global markets that you won't hear echoed in the sanitized headlines of Western financial news. Just days ago, on a crisp Friday in February 2026, multiple government agencies banded together to issue a thunderous joint statement, zeroing in on everything from leveraged apps, luring in everyday investors to live streams, hyping bullion sales like the latest viral sensation. The official line splashed across state media. Phrases promising skyrocketing gold values or easy riches from precious metals are now verboten, strictly prohibited in any retail pitch. Pause and let that marinate. A superpower with 1.4 billion people is essentially outlawing optimism about gold, criminalizing the very buzz that's fueling a frenzy. This isn't some backwater edict. Shenzhen isn't just any city. It's the phoenix that rose from a sleepy fishing village to command the planet's biggest gold trade, where billions in bullion change hands daily, and where the air hums with the clink of bars and the whisper of deals that shape global supply chains. When a government clamps down this hard on mere words, it's a neon sign flashing desperation, not over fading interest, but over demand so ferocious, so all-consuming, that it's buckling the system's foundations. You don't muzzle sentiment unless that sentiment is a tidal wave crashing against your control mechanisms. Unless bullish chatter is herding millions into behaviors that defy your carefully scripted economic playbook. Far from a death knell for gold and silver, this is the ultimate bullish flare-up, a tacit admission from Beijing that retail hunger for hard assets has spiraled into something they can't corral. And the ripples, they crash straight into the data points we've been dissecting for months. Soaring Shanghai premiums that scream scarcity, vault depletions at COMEX that Western pundits conveniently ignore, and a worldwide physical crunch that's rewriting the rules of monetary survival. To grasp why this Shenzhen showdown is the canary in the coal mine for every investor eyeing precious metals, we need to peel back the layers of this coordinated assault and see the raw forces at play. Picture the scene. It's not a lone bureaucrat firing off a memo. This was a full-spectrum barrage from regulatory heavyweights, laser-focused on the wild west of retail gold chasing. First up, those apps dishing out leverage to mom-and-pop traders, tools that let ordinary folks borrow big to bet bigger on gold and silver swings. What does that reveal? Chinese savers aren't content with staid savings accounts or tepid ETFs. They're diving headfirst into amplified plays, mirroring the mania of a market top or, more tellingly, the blind panic of a populace ditching a wobbling currency for the unyielding security of metal you can touch. It's the digital equivalent of storming the vaults, a sign that faith in the yuan's stability has eroded to the point where leverage feels like the only accelerator pedal left. Then there are the online live streams, those electrifying broadcasts where influencers hawk bullion bars like hot commodities on a flash sale, whipping up audiences in the hundreds of thousands, maybe millions, into instant buying sprees. This is precious metals reborn in the TikTok era, gamified, social, urgent, a far cry from the hushed boardroom trades of yesteryear. Your grandparents might have tucked gold under the mattress after a quiet bank visit, but today's Shenzhen youth are scrolling feeds for the next drop on sovereign coins, turning ancient wealth preservation into a spectator sport that's exploding the traditional gold ecosystem. The frenzy peaked so high that regulators had no choice but to pull the plug, lest the spectacle spiral into outright anarchy. And don't overlook the scammers impersonating Shanghai Gold Exchange insiders, crooks donning fake badges to siphon retail cash, a plague born of opportunity where demand runs hotter than a forge. Fraud festers where fortunes flow. These schemes didn't sprout in a vacuum but from soil so fertile with buyer zeal that pretending authority pays dividends. It's proof positive, the appetite is authentic, the volume colossal, the vulnerability heartbreaking. But the kicker that truly exposes the underbelly? Shenzhen's explicit ban on peddling adulterated fakes, alloys dressed up as pure gold or silver, counterfeits flooding the market because desperate hands are grabbing whatever glitters. When folks are queuing around blocks for bullion and ending up with plated disappointments, and when shady operators scale up the deception to meet the void, you're staring at a supply chokehold in disguise. This isn't a glutted bazaar with bargains aplenty, it's a siege where physical metal commands premiums that laugh at London fix quotes, where official prices mask a shadowy scramble of gray market markups and back-alley barters. The infrastructure's creaking under the weight of wants it was never built to bear, and the government's knee-jerk is to outlaw the symptoms rather than flood the pipes with more supply. Now zoom out to the platform that lit this powder keg, Jiaowari, one of countless nimble fintech outfits that mushroomed across China, seducing retail punters with slick social media ads touting turbocharged returns on the gold bull. What went sideways? Buyers flooded in, funds vanished into thin air, and suddenly you've got throngs clashing with cops in the streets, a spectacle rare enough in China to rattle the halls of power. Local bigwigs responded by spinning up a dedicated task force to babysit the operation, a band-aid on a gushing wound of unmet expectations. This isn't mere malfeasance, though plenty of that simmered beneath. It's a dam bursting from upstream pressures too mighty to contain. Investors overlooked the warning flares, blinded by the allure of safeguarding wealth in a storm, only to watch their stakes evaporate when the pipes proved too narrow for the torrent. Western outlets might gloss over the spark, but it's no coincidence. This gold rush erupted amid China's real estate implosion, where once mighty property empires crumbled, leaving households staring at evaporating nest eggs. Layer on yuan strains from relentless money printing and ballooning debts, and you've got a perfect brew for fiat flight, the same cocktail bubbling in boardrooms from Mumbai to Manhattan, but supercharged in a nation where capital flight's handcuffed by controls, stocks swing wildly without mercy, and alternatives dwindle to dust. So the cash cascades into gold, into silver, into the timeless bastion that's outlasted empires, immune to the printer's whim, the defaulter's dodge, the sanctions snare. It's the identical calculus propelling central banks to hoard bars at a clip unseen in generations, juicing Indian wedding season imports, inflating Shanghai spreads, and siphoning COMEX silos dry. Players vary. Retail rebels, policy wonks, family jewelers, but the verdict's unanimous. Tangible triumphs over translucent IOUs. Shifting gears to silver, where the squeeze bites even deeper. Shenzhen dispatches paint a portrait of front-month futures on the Shanghai exchange trading at premiums to distant contracts, a textbook backwardation that flips the commodity script on its head. Near-term silver costs more than what's slated for later delivery, a premium born of buyers clawing for immediate gratification, willing to pay up because the spigots for spot supply are sputtering. This inversion bucks the norm, where future dates bake in storage fees and times tick. When the curve kinks backward, it's the market's megaphone blaring tightness, a clarion call that inventories are evaporating faster than mist in the morning sun. And the numbers? SHFE and SGE warehouses have hemorrhaged to depths untouched in over a decade. Stockpiles scraping 318 tons, barely 10 million ounces, an 88% evaporation from peaks, stripping away the buffers that once ironed out ebbs and flows. No more shock absorbers. Today's demand spike slams into bare rock, amplifying every tremor. In response, SHFE tweaked its playbook, barring certain traders from rolling silver futures to physical unless they've snagged a hedging carve-out, a velvet-gloved gate on delivery, rationing the metal lest the exodus empty the vaults entirely. It's a page ripped from COMEX's own manual of managed scarcity, where cash settlement nudges and rollover rewards keep paper pyramids from toppling under physical pulls. If you're sensing echoes beyond the Great Wall, you're spot on. COMEX registered silver has dipped under 100 million ounces to 98 million, with weekly outflows unrelenting. March open interest towering at 300 million claims against that slender stockpile, a mismatch that mocks math without mass rollovers or fiat fudges. Both exchanges grapple the same specter, industrial maws and investor avarice outstripping mine outputs and recycling scraps at prevailing tags. The fracture lines are faulting, either tags telescope to throttle thirst and tease more tons from the earth, or edicts evolve to barricade the handoff, or inevitably, the apparatus shatters under strain. This Shenzhen salvo slots seamlessly into the saga we've shadowed. Chinese gold ETFs slurped in a record RMB 44 billion $6.20 billion in January 2026 alone, the second fiercest influx ever, capping 5 straight months of mania. The lone silver fund? Overheated to the brim, inflows overwhelming the valves. Meanwhile, Shenzhen's Shuibei jewelry quarter devolved into bedlam, its dealers titans of tonnage overrun by mobs morphing trade into tumult, birthing scams, standoffs, and the regulatory riposte we now dissect. That riposte underscores persistence, not palliation. Weak wants warrant no such wrath, no verboten vocab, no surveillance squads. The ferocity of the fix mirrors the frenzy's fire. Notably absent, tackles on root rot. The property purge, currency convulsions, banker distrust. They swab the sweat, sidestepping the sepsis of sovereign script's slow bleed. It's the perennial ploy in fiscal fevers, scapegoat the speculator, straitjacket the surge, skew the scales against unvarnished valuation. Anything but autopsy. The ailments hurting hordes from holograms to heft. History's ledger is littered with parallels. FDR's 1933 gold grab in America, criminalizing citizen caches to prop the dollar's delusion. India's import irons and tax torques, engineered to starve the shine from subcontinental stockpiles. Every epoch when the masses murmur mutiny against minted mirages, mandarins muster the same maneuvers, yet chronicles concur, curbs crimp, they don't kill. They reroute the river, birthing bazaars in the shadows, bloating bids in the light, deferring the deluge till it drowns the dikes. What we're witnessing in China is a dress rehearsal for the dominoes when demographics defect en masse from digits to durables, when the conduits clog and the commissars commandeer, only for the undercurrent to undercut anew. The mandate endures because it's not madness, it's math. A methodical migration from monetary mirages amid manias that mock stability. Now, let's layer in the ledger of late. Gold vaulted to vertiginous vistas through January 2026, cresting $5,066 before a breathy retreat, volatility veiling but never vanquishing the ascent. Silver mirrored the melee, lunging to lofty ledges then lurching low, now nestling in consolidation with gold's grit granting it greater guard-engaged gains. For the white metal, eyes etch on $77 as proximate perch, a puncture there ports peril to $70, while ceilings cling to cycle crests. The 150-day EMA on dailies decrees direction for desk jockeys above, ascent, astride or adrift, await. Yet charts chronicle but a sliver. The somatic saga sings a sharper strain. Shanghai premium's perch persistently puffed, a persistent premium pulsing physical's primacy over paper proxies. SHFE silos scrape decade dregs. Delivery decrees dialed to deter the draw. COMEX claims cascade ceaselessly. Central's coffer at cadence unseen since the 70s, 755 tons forecasted for 26, with China's coffers claiming consecutive conquests. When ledger lines and lifelines diverge, discord demands decree. Either ethereal equities eclipse the earnest, cratering crave, or the corporeal crusade compels convergence, compelling costs to calibrate to the crush. The ledger from Liuzhou to London leans latter. The ledger of longing looms larger than ledgers of liquidity. Tailoring this tumult to tactics, consider your corner. If you're charting contracts, honor the hieroglyphs, thresholds, tether trades, even as epochs endorse endurance. Bullishness in the buy and buy buys, no berth against a barb in the brief. Bridle bets, ballast positions, let lore not lash logic. For the faithful forager of forms, the feints are fortunes. Shenzhen's saga seals that the globe's gold Goliath grapples glut-free, every ebb an enticement to ensconce at equities eclipsed by Eastern extras. Dollar dribble your durables, dodge the diviner's dice, deposit deliberately and defend the depot. Sideline sentinels, sizing the sally, survey the spectacle, a planetary peeling from paper pedigrees, patent in protests where promised purity proves phantom, in edicts eclipsing ebullience to embargo excess, in exchanges etching exclusions to equilibrium, in entresols emptied to echoes. This transcends the quotidian. It's the quaking of a quadragenarian fiat foray fracturing at the fissures. To temper the tail tender the tailwinds thwart. Gold and silver staggered post-January zeniths, spasms spiking, scars scoring the short span. Shenzhen's shackles might sap the swarm if wielded with whipcrack. SHFE strictures stanching the spill to steady stocks. Yankee yield hawks hovering high could hoist the greenback, hammering havens. Downturn dreads dimming factory feeds for the gray gleam. Levered legions lurk to liquefy on lurches. Long litanies lost to lightning. These thorns, tangible, not trifles. I'll not elide their edge. Yet the rebuttal rebounds robust. The clamp confirms the colossus of crave. You quash not quiescence but quake. The strictures spotlight the straight, spigots spared no straitjacketing. Silos at secular troughs testify to the toll. COMEX cascades corroborate the contagion. Central's cash at chronic clip cues the cognoscentes calculus. Shanghai surcharges signal somatic sovereignty. ETF engorgements. 44 billion yuan in January's juggernaut. Jolt the juggernaut. Jiworry jitters journal the jugular of jeopardy. Each datum from this dragon's den douses doubt, dubbing the durable's destiny, despite the durance. The durance, vindication, not verdict. As the calendar creases, calibrate these compasses, clock if Shenzhen's snare snares the surge, or shunts it to sluices subterranean annals, augur the latter, the latent lapping louder. Gauge Shanghai gauges when the gong resumes. Persistent or proliferating premiums port physicals unflinching. Track SHFE stacks. If seepage sustains sans the straitjacket, the scourge outstrips statute. Monitor COMEX's 98 million morass. If the melt maintains, the mismatch metastasizes. Mark gold's march to the millennial mark. If it hunkers high, the satellite silver surges in sympathy. Mine monthly missives on monetary mandarins. Their metrics most mirror the macro malaise. Mine for mimicries manifold. If Indus inspectors ink import inks or other overlords occlude the Oriental outbreak's no outlier. This is the crucible of coinage conflict. The codex of when the craving crests the capacity. Shenzhen's stricture is the stencil. What befalls when the flock flees the facsimile and flotilla? The portals pinch, the protocols pivot. The parlance patrols, but the pulse persists, percolating through the penumbras, the pluses, the byways, the build-up to breach. Beijing can blackball the ballad of bullion's boom, but not the boom itself, not the bedrock birthing the ballad, not the barrenness breeding the buy. They can cauterize the cutaneous, but the core corrodes unchecked. We're waiting the waning of a quinquagenarian quest in unqualified quackery, the quester quailing. Indebtedness indurates to a memorial immensity. Mintmasters mislay the muzzle on the monetary maelstrom sans the salve. debasement darts, fealty phrase. From Forbidden City's fringes to the Fed's fount. From Ganges glitter to Goldbug's garages. The epiphany echoes. Exchange the ether for the eternal, the escrow for the estate, the echo for the emblem of epochs. The Shenzhen scrimmage isn't a sidebar from a cynic suburb. It's the skylight into the spasm when the sprint outstrips the scaffold, the harbinger of the havoc as the hydra heads home. Heed the heralds, hone the hunches, harness the horizon, and hedge hence. If this dispatch demystifies the dragon's dilemma and its dividends for the durable's domain, disseminate it to a compatriot craving clarity. Stay stitched to the signal, let the ledger, not the loudspeaker, lead. We'll reconvene in the ripple's wake. The Shenzhen saga, in its searing specificity, serves as a stark semaphore for the seismic shift stirring beneath the surface of global finance, a reminder that when the world's most populous powerhouse moves to muzzle the market's most ancient asset, it's not just local lore, but a global gauntlet thrown down against the fragility of fiat facades. As we've traversed from the crackdown's crude contours to the cascading consequences for silver's squeeze and gold's guarded gains, the through line thrums clear. This is no isolated incident, but the inflection point where retail resolve meets regulatory recoil, where physical primacy punches through paper pretensions. Central banks, those colossi of caution, continue their chronicle of accumulation, with projections pegging 2026's haul at 755 tons, a tempered torrent from prior peaks, yet a testament to the trepidation threading through treasuries worldwide. China's own custodians, unyielding in their uptake, marked their 15th straight month of metal mustering in February, a streak underscoring the sovereign's stake in the stuff that outshines scrip. And in the exchange's entanglements the evidence endures. Backwardation's bite on SHFE silver, where April contracts command $4.90 more per ounce than August's, a $6.15 gulf to December, a geometry of greed that geometrizes the gripe for goods. Now not anon. Warehouses whisper warnings, their 318-ton whisper down 88% from zeniths, a dirge for the depleted, a decade's dusk demanding dawn's deliverance. COMEX's counterpoint, at 98 million ounces registered, echoes the elegy, eligible metal eclipsed by eightfold in ethereal entitlements, a equation edging toward either exaltation or explosion. Yet amid this architecture of apprehension, the allure abides. For the accumulator, it's the axiom that adversity amplifies the asset's armor. For the trader, the truism that turbulence tests but tempers the trend. For the novice navigating the nexus, the narrative that now's the nexus of necessity, where the narrative of neglect yields to the necessity of nesting in the nonpareil. The bear's barbs as bared bear biting. The post-peak plunge, the prospective pruning from policy pincers, the potential parity in premiums if the prohibitions percolate. But the bull's ballast, buttressed by the barrage of bullish beacons, the ETF exodus to equity, the exchange's evasions, the enduring drawdown outweighs the worrisome whispers. In the end, as the embers of this episode ember, the essence emerges, the experiment in endless expansion edges toward its epilogue, and in that elegy, the eternal endures. Eyes east, but ever eastward in implication. The dragon's decree is our directive, the demand's defiance our due diligence. Position with precision, persist with purpose, the precious prevail.